What is the PE ratio? The PE ratio stands for price to earnings ratio. It's a simple way of asking how expensive is this share compared to the money the company makes. You calculate it by dividing the share price by the earnings per share, EPS. For example, if a share costs £20 and the company earns £2 per share, the PE ratio is 10. In plain English, the PE ratio shows how many years it would take at the current level of earnings for the company to earn back the price you're paying for one share. Why does it matter? The PE ratio helps investors decide if a share looks cheap, expensive, or fairly valued compared to its profits. A high PE suggests investors are paying a lot for each pound of earnings. This can mean the company is expected to grow strongly in the future, often called a growth stock, but it can also mean the share is overpriced. A low PE suggests investors are paying less for each pound of earnings. This might mean the share is good value, sometimes called a value stock, but it could also mean investors are worried about the company's future. For beginners, the key point is the PE ratio adds context to EPS. It tells you not just how much profit the company makes, but how much people are willing to pay for it. On a practical level, this helps reduce guesswork. Instead of being swayed by hype or headlines, the PE ratio gives you a quick check on whether you might be overpaying. Here's a simple example. Imagine two companies, both earning £2 per share. Company A's share price is £20, so its PE is 10. Company B's share price is £40, so its PE is 20. Company B's earnings are the same, but investors are paying twice as much for each pound of profit. Why? Maybe they believe Company B will grow quickly, or maybe the market is simply overenthusiastic. This is why the PE ratio matters. It highlights how much optimism or pessimism is built into the price. What else should you know? The PE ratio isn't perfect. Different industries naturally have different PE. For example, fast-growing tech companies often have high PE, while stable utility companies may have lower ones. So it's best to compare PE between companies in the same sector. There are also different types. Trailing PE looks at the past 12 months of earnings. Forward PE uses analysts' forecasts for the next 12 months. It's also useful to know that historically, broad markets such as the S&P 500 have often had average PE in the mid-teens to low 20s. That gives a rough benchmark, but remember, normal can change over time. Importantly, the PE ratio can be misleading. Some people assume low PE equals bargain or high PE equals overpriced, but that isn't always true. A low PE might signal problems, while a high PE could reflect strong future potential. And if a company is losing money, its PE ratio won't be meaningful, because you can't divide by negative or zero earnings. Finally, the PE ratio doesn't tell you everything. A company might have a low PE, but also huge debts, or a high PE, but an amazing new product coming. That's why investors use it alongside other measures, not on its own. To sum it all up, the PE ratio compares a company's share price with its earnings, giving investors a quick way to judge value. A high number suggests growth expectations, a low number suggests caution, but neither is good or bad on its own. Think of it as the price tag on profits. It tells you how much you're paying for each pound of earnings, but it works best as part of the bigger picture. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.